Welcome to this video from efinancialmodels.com. In this video, we're going to review how to best prepare a financial plan for starting or buying a coffee farm or a similar operation in agriculture. Our objective is to prepare a multi-year financial plan and forecast which we can show to a bank or to investors, and also which allows us to better prepare and plan for the financial success of our project. One particularity about coffee farming is that you will have to wait several years from the planting of the tree until you can obtain the first harvest from the coffee bean. During that period, you might only have expenses and no income in your business. Therefore, it is very important to also think about the timing and phasing of your different plantings, so that later on the harvests will generate steady cash flows to your business and your business becomes more stable. For our analysis, we will use a financial model template from efinancialmodels.com. So let's get started and let's dive into it. We are going to build a financial model with a forecast period of up to 10 years. This model will keep track of all the lands, the different operational indicators, and build schedules for the balance sheet, cash flow, debt schedules. Basically, quite a comprehensive forecast we're going to build. We will have a look later at all these schedules, but where to start is we have to start with the assumptions sheet. The first thing we're going to do is to define what are the land areas we have available, which we'll take under management, what are their sizes, when are they added to our project, and then we also will need to define if any of these lands will become due for new plantings, which year will that be, and when they are up for planting, we also have here an assumption which will tell us, or which will calculate then will take us 3 years, in this case 3 years forward, and that will be when we have then the first harvest. Then each land can either be rented or owned. We're also going to specify that so that we can calculate based on this what's the foreseeable rent expense, or if we have to purchase the land for expansion, what we can apply a purchase cost. We have that down here, how much we're going to pay per hectare. The next assumptions we will have to set are the yields. What are the harvest yields in this case per hectare? Is there any change in yield and yield improvements? We will set the prices, the average price we can get. Here we have two pricing categories. In this case, we also have to define the split. This cannot be more than 100%. So in this case, we just go with coffee class A. And then that's pretty much, we have the lands, we have the yields, so we have the volume, and then we have the prices, so we have the revenues. The next set of assumptions we have to go through is the capex and opex. We start with the capex. So initially, how much we have to spend to get started. We have to spend some amount in the acquisition of the lands. This is just these are just example figures we will use for our example spreadsheet here. Then we also might have other capex items. We're just going to list those. Then apart from that, we will need to define what are the direct costs. So direct costs, there are different costs. Planting costs, they only occur at the time of planting. So how much are these costs going to be? Then the growing costs, these will apply to every year where we have the lands under management. And then the harvesting costs, they will only apply to all the areas which become due to be harvested. And processing costs, these costs will then only apply to the harvest volume. This will be the expected cost structure for our coffee farm. Then in terms of OPEX, these are the fixed costs. We can enter here our budgets, what we think we're going to spend per year for our fixed costs, and then we can build easily a budget here. Then we need to work through the capex assumptions. Here we differentiate between the initial capex and the ongoing capex. Initial capex is what you will have to spend to get the coffee farm started. We expect that the land will be the major cost position. This here per default is a formula which multiplies the land purchase price via all the areas you're going to add here in the starting year. And then all this together will give you a ballpark figure, and important to keep in mind, this is a major cost position which will require financing either through debt or through equity financing later on. Ongoing capex is what you have to spend on a yearly basis to keep the equipment in order or to do small additions. One thing to note here is that the land budget or acquisition budget could vary quite a bit. Here it depends when you're planning to add new land areas and the price you're going to or you have to expect to purchase it. So this position might depend on your ramp-up plan. And then these capex assumptions will lead into this forecast, which you also can revise and fine-tune later, or we'll have to revise and fine-tune later on. Then we also have to work through if we get debt financing, what will be the terms, what will be the bank covenants. Then we can also define the dividend policy, which is the year when we will start to pay some dividends, or if we are not going to start any dividend payments, then we just put that to basically to 0. Then we also shortly review our uses and sources of funds budget. So this is calculated already by the model. What's the total capex required? This covers the whole forecast period, so there is some contribution from first revenues, but these items mostly will have to be funded upfront. And then the question is if we can get some debt financing, we enter the amount here, and then the model calculates what will be the required equity financing amount. Then this value here will tell us that the funding period where we have to inject capital into business, that is phase, will take two years to complete. Then we also can enter the exit valuation, what we expect at one point when we want to, when we would have the option to sell the business, at what valuation we could do that, and in which year we could do that. If there is nothing foreseen, we just put it at the end of the forecast period. Exit multiples, we can either choose a multiple of revenues, EBITDA, or also, in this case, EV per hectare. So there are different ways to model that, and you can just select the method, and then it will take the applicable input multiple. So we have pretty much, quite quickly, we have set all the required assumptions. There are some more assumptions here, but they're more generic. You can, of course, you can revise them as you feel like. Then we will check the schedules. So the first schedule to check is the land. So land under management. Does this make sense? We will start here with 90 hectares, then we'll add some more hectares here. If you see that this schedule needs to be adjusted, all you need to do is to move these lands around when new lands will be added, or sooner or later, or also leave it to as you like it. You can this can be set, but it should be planned so that there's a clear plan how many hectares will be under management per year. Then we also, as we have entered which lands will be owned, which ones will be rented, we can calculate per year. We can obtain a view on what will be the owned and rented areas basically per year. Then newly planted areas. So here is now where the planting schedule kicks in. All these lands which have plantings in year 0, they are entered here. They would be acquired, freshly planted. And the other ones we will have to plant, these hectares would be planted as per this schedule. And this also means we now can project the harvested areas, and you can see these gaps here are because the land was planted here. They need 2 years to grow. Then in the 3rd year we will have the first harvest. When we now set these schedules in a way that every year we have a certain amount of area harvested, we can ensure that there is never a lack of cash in the business. There is always land to be harvested, which make our business stable and less risky. Then we also go through the operations schedules. This starts with the inflation rates. Over a longer period, there is some inflation to be taken into account. The question is how many percentage per year prices and costs might increase, so this has to be forecasted. Then we review the production volumes. We see what's the harvested areas, what's the yield, and from that we can calculate the expected yearly harvest volumes. Once we have the harvested volumes, we then can calculate the production volumes depending on the bean classes. Here it's very simple, we just have one class of beans assumed. Then we review the prices. The prices also, they can change per year. They were basically linked to the inflation assumptions on top. So the question is, do these prices change or not? So we will have to take a view what we think these prices are going to develop. And then once we have all this, then we will be able to have forecast the revenues. And in case there are any other revenues, we can also would have to take them into account. For the direct costs, these depends on various volume assumptions. Here, land under management, new planted area, harvested area, what will be the projections for those. And then depending on these parameters, we apply the cost structure, either per hectare or per kilo, and we can obtain the forecasted direct costs. For operating costs, we make it a bit easier here. All we need to do is to enter the yearly budgets, and then we project those budgets. If those budgets would change, we could overwrite them. Then we also need to calculate depreciation. So we need a model which has these depreciation schedules that we can, for each of these asset classes, we can calculate what's the yearly depreciation and then add up and to basically know what will be the forecasted depreciation figure. The next schedule to check is the debt schedule. Here we first start with the details. So if we can get some bank financing, the question is in which year this is going to be drawn down. So we overwrite this year and enter the percentages of the facility when they become available. This will then reflect in a drawdown schedule, and then we can also enter a repayment schedule. And this needs to be updated, and once this is updated, we'll have the end of year debt balance. We'll also have the interest. We can calculate based on that the interest by applying this the interest rate, and then we also have a debt schedule here. This will be a summary where we can check if the bank covenants are met. If you remember, we have here a way to enter the expected bank covenants. So the bank might tell you these are our lending limits. We only lend you up to, let's say, 3 times EV/EBITDA. We have certain covenants regarding interest coverage, debt coverage, and also about how much we're willing to lend on a per hectare basis. And then this schedule here allows us to check where these limits are okay and where are these limits exceeded. If they are exceeded, what we'll have to do is we'll have to go back and play around with the debt financing assumptions, either reduce the amount of debt or move the cash flows and the ramp-up plan or the expansion plan a bit around so that this can be optimized. So that's the idea of this model, to make this easy to check and optimize. Then the next sheet we now can review is the financial sheet. So we'll have here the projected profit and loss statement or income statement. And you can now see that here the revenues are going to increase as more and more lands are taken under management. We can then check what's the gross profit margin based on our cost structure, what's the EBITDA margin, depreciation, profit, net income. We can obtain a proper view what will be our forecasted profit. Then the next schedule to check is the balance sheet. Here we can project how this is going to develop. Might also want to think about receivables and inventory. In this case, it's all set to 0, but who knows, maybe there is some. So the call would be to think about this. For instance, here, if this each is 30 days, just to make an example, the consequence is that this position will grow as the business grows, and this will also have an effect on your cash flow, as some of your cash will be invested in, for instance, inventory, receivables, etc. And this already brings us to the cash flow statement, which now we can understand how much is the cash flow from operations, investments, how much and when do we get the financing, what will be the repayment schedule of the debt, and then it will calculate us the end of year balances for the cash. So that's a bit how we can do this forecast. There are more schedules in here where you can see many more details. These are probably more of interest to a bank or also to another financing provider like an investor. Another interesting schedule to look at is the projected valuation. So if we know what these figures are going to be, we also know the multiple, then we can basically project and predict what will be the expected business valuation several years down the road, and we can also plan by when the valuation reaches the goal in case we would like to exit. So all these schedules need to be summarized and presented on executive summary so they're quickly to understand. We also want to double check if these graphs make sense and basically reflect our ramp-up plan. And then we also will have a check on the overall project feasibility. We also have a schedule where we calculate the unlevered and levered free cash flows. And what we want to see is that this is also profitable already on an unlevered basis and also on a levered basis, so that we can basically validate that our plan should be financially viable. So this is more or less how you can plan the start or the purchase of a coffee farm. So I hope this video was useful and gave you a good idea how you can start preparing a financial plan for your next coffee farm. If you liked this video, please give it a thumbs up and hit the bell button to subscribe to our channel. Please also visit our website efinancialmodels.com. A link to the model is included in the description below. Thank you for watching.